So there is persistence to some of those periods where private outperforms the public or public outperforms the private. So the point of all of this is that more stronger, more robust portfolios can be generated by thoughtfully combining the private and public segments of real estate. Again, with the private real estate serving as the foundation and REITs serving as a complement.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Joining me today is Pulkit Sharma, Head of the Alternatives Investment Strategy and Solutions Business at JP Morgan Asset Management. Pulkit is here to talk about the evolving landscape of real estate investing and the benefits of a diversified approach that integrates both public and private strategies. Pulkit, welcome to the podcast.
Glad to be here, Sarah.
So to start off, maybe you could explain your overall strategy and investment goals as it relates to alternative investments more broadly.
Absolutely. So I run the Alternative Investment Strategy and Solutions, short for AISS team, which is a multi-alternatives platform at JP Morgan. We build diversified portfolios for both institutional and private wealth capital globally, combining various private market asset classes and also private markets with complementary public markets to solve for different client objectives. Now, maybe I'll highlight why we do what we do as well as how we do what we do. So in terms of why we build diversified portfolios in the broader alternative asset class, I could sort of summarize it into these three phrases we use, which is when it comes to alternatives today, we believe more is better in client portfolios, broader is better, as well as active is better. More is better because alternatives on average in executable forms produce a return premium versus their public market counterparts. They also have inflation linkage and they are diversifying versus broader public stocks and bonds. So hence there's a bigger role which they are playing and will continue to play in client portfolios. Broader is better as another matter of principle is because in the alternative space, unlike public equity categories or public bonds where the intra-category correlations tend to be much higher, alternatives in general are much lowly correlated with one another. So broader portfolios can preserve returns but mitigate some of that downside risk which exists. And then active is better because in alternatives there is two types of dispersions and both of them are very high, which is on one end there's manager dispersion and the other there is asset class dispersion, and both of those dispersions are quite high. So this leads to the importance of portfolio construction and portfolio management for sizing position and evolving exposures, which is very important for clients to think about. And in terms of how we do what we do, we believe that today, if I flash back today versus 10 to 15 years ago, there's a vast amount of data which is available today, which was not available 10, 15 years ago. So using that data, thoughtful long-term insights in terms of risk-return correlations could be constructed as well as near-term convictions are also possible to be generated. So long-term and near-term insights can then lead to a more science, less art-based or a more stronger portfolio design where outcome-oriented portfolios can be generated to solve for different client problems like income orientation, growth orientation, or combining both income and growth categories. And a lot of this work around the framework for building alternative portfolios we worked on at JP Morgan where we put out a research piece with GIC Singapore, which is titled Beyond Finger Painting, Building Active Multi-Alts Portfolios. You can find that on JP Morgan website and also find that in the notes to this podcast.
So what are some of the main reasons for including real estate in a diversified investment portfolio during a range of different market conditions, including periods of uncertainty such as what we're seeing today?
Yeah, I can think of three reasons why. Firstly, it's the outcome reason. So real estate, unlike other broader segments of alternatives, such as private credit, which is more income-oriented, or private equity, which is more growth-oriented, real estate is a truly hybrid asset class. It has both income as well as growth characteristics in its return streams. It's also, as we think about it today, a lot of the repricing started in real estate in around 2022 when interest rates began to rise. And a lot of that repricing is behind us. So in the recently concluded capital market assumptions which JP Morgan put out, which is our forward-looking projection for asset classes over the next 10 to 15 years, real estate stacks up as one of the highest returning categories. In fact, its forward-looking return is the highest we have seen in the last 10 years. So it ends up having equity-like return characteristics, but a risk profile for broadly diversified private real estate at somewhere between equities and fixed income. So that's the first reason, which is the outcome reason. And the second is those outcomes actually come with degrees of inflation sensitivity, which is embedded in the real estate return streams. And also, that's could be from rents or valuations or the fact that real estate cash flows can grow. The second reason beyond the outcomes itself is that real estate return streams come with inflation resilience as well as diversification. Inflation resilience is important in today's market environment with geopolitical forces and policy environments, which is actually creates stronger linkage between stock and bond returns. So real estate acts as a stronger inflation-sensitive asset class. It's also a diversifier because a lot of the returns are coming from local economic forces, whether it's the cash flow growth or the risk premia. It has local drivers, so it tends to be more uncorrelated to both public equities as well as bonds. And the third reason that real estate is one of those evolving asset classes where you can place certain themes which are secularly strong themes in the economy today, whether it's it provides access to those themes. So, for instance, demographic themes or the aging population, the advent of senior living is a sector which is mainstream in the public and private real estate space. You can access that to take advantage of that theme or secular demand for senior living. And the other is the tech and AI theme, which is embedded in the data center assets, which are also becoming more and more mainstream in both public and private real estate segments.
Could you talk a little bit more about the extent to which public REITs differ from private real estate funds in terms of their sector exposure, liquidity, and overall flexibility?
Sure. I'd like to say that if you look at a building and imagine a building in your mind, a building actually does not know who its owner is. The owner of a building and the cash flows it generates could be a REIT or it could be a private real estate strategy. So that's basically the wrapper on the building, which actually makes all the difference. So talking about some of the differences which comes from the wrapper itself, there are both advantages and disadvantages which different wrappers have. And we believe that public and private real estate are very good complements to each other. So from the advantage side, REITs have a different sector blend. They are more liquid. They offer more flexibility. At the same time, the private side comes with a little bit lower risk profile. So if we double click on these points, on the sector side of private real estate, core exposure is in 4 sectors: office, industrial, retail, and multifamily. Whereas REITs only have 50% of their exposure to these 4 traditional sectors. 50% of the REIT exposure is in extended sectors such as senior living, self-storage, data centers, and the like. And these tend to be slightly higher growth in nature. REITs are, of course, daily traded on the exchanges, whereas the liquidity in the private core real estate strategies is quarterly and best effort. Because of their daily traded nature, the sector blend in REITs can be more flexible, where it's harder to evolve exposures in the private real estate segments. So while those are advantages which REITs offer, on the risk side, REITs tend to have slightly higher volatility. And when we do the math on volatility in real estate and adjust the return streams for smoothing and correct and take out the autocorrelations, we find that REITs are at least 1.5 times more volatile than the private real estate space. And why is that? That explanation for that really comes from a few sources. Firstly, as we talked about, the sector blend is slightly different. So those higher growth sectors tend to have slightly higher volatility. The leverage level of REITs is slightly higher than private core universe. That's the second contributor. And the third contributor, probably the most important one, is that REITs are actually bought by the equity buyer, the bond buyer, and the real estate buyer. So they evaluate REITs differently. Whereas private real estate is typically bought by the private real estate oriented buyer. So hence, due to these advantages as well as considerations, we believe that both of them are really good complements to each other. So it's not about either or, it's the combination or the sum of the parts which makes for stronger real estate portfolio construction.
And do you have a recommended allocation between REITs and private real estate? And what else should investors consider when structuring an efficient and effective portfolio?
Sarah, if you give me a blank piece of paper and there were no objectives or no constraints, then we would sort of suggest an anchor allocation to private real estate, around 60 to 80% of the exposure, and a complementary allocation to REITs, roughly 20 to 40% of the exposure. And that blend generates the highest risk-adjusted returns. It has a holistic sector exposure and is also a more flexible allocation. If we add REITs more than the 20 to 40% mark, then they start adding or dominating the risk profile of the portfolio. There are a couple of differences which REITs have versus other public and private pairings when we combine private real estate and public real estate, which are quite unique and worth talking about. Firstly, REITs have 50% of the exposures to extended sectors, which is only 10% in the private core real estate universe. It's quite fascinating that a lot of the innovation and the alternative sectors are then first born in the public real estate space, and then they become mainstream in the private real estate space. Probably because of the fact that REITs have more flexible structures, its ability to raise capital, fund capital needs, and adjust these sector exposures is more nimble than the private real estate space. We don't really find that in other pairings, where a lot of the innovation happens in the venture space or the growth equity space in the broader private equity universe, whereas we see that happening more in the REIT space. The second point, which we find unique in the public and private real estate pairing, which is not found in other public and private pairs, such as in public and private equity and public and private credit, is that while public and private real estate offer almost similar returns, whereas REITs might be slightly higher because of their higher growth sector exposure as well as due to leverage, the volatility-wise, REITs volatility is more akin to equity-like, whereas private real estate volatility sits between equities and fixed income. Now, if we look at private and public equity, so private equity actually has a return premium to public equity, which comes from leverage or the operational alpha, which is embedded in some of those companies. However, the volatility profile of both public and private equity is quite similar. Whereas in the pairing of credit, where we look at private credit to public credit, private credit also has a significant return premium to its public credit counterparts, stemming also from the fact of higher leverage as well as the terms in which the loans are designed. But private credit tends to be more volatile than its public credit counterparts, such as high yield or levered loans. So what it does tell us is that the pairing is actually the strongest in public and private real estate space, where stronger portfolios can be designed by combining them. And one other point I'll say on why REITs can act as a complement and can be additive is the fact that a lot of these alternative sectors, as we talked about, are again mainstream in the REIT space, and it's also easier to access developing an emerging market through the through REITs than where we find that in developed markets and more traditional sectors, the private core universe tends to be the more mainstream way of accessing those exposures.
And can the lead-lag relationship between REITs and private real estate be used for tactical investment decisions?
Yes. So when we look at this lead-lag relationship, it's just quite prevalent actually in that REITs tend to reprice down faster and reprice up faster. Looking at least at the last 15 years of data, we can find this relationship. A lot of that can be explained by the fact that, again, REITs are evaluated differently as from equity buyer lens perspective or bond buyer or real estate buyer. So there are these valuation differences which get actually magnified at points of inflection. When you combine that fact with predictive analytics or looking forward and analyzing the behavior of public and private markets, then I can sort of come up with the 3 R's of how that lead-lag relationships can be used tactically. The first R is that we can use that for return enhancement by capturing some of that dispersion which exists between the two on an ongoing basis. The second R is that we build rebalancing flexibility. So from private into public markets or public into private markets across the real estate universe. And the third R would be you can return capital to do stronger liquidity management, at least at the times where, for instance, REITs appear overvalued. They can work as a stronger source of liquidity and liquidity management when the two are combined together. Now, in terms of how the tacticality can work in practice, we at JP Morgan spend a lot of time on analyzing the behavior of public and private markets. We look at that in real estate, and we look at that from 3 lenses. Firstly, a bottom-up lens where we analyze each and every sector and its fundamentals. The second is we look at a macroeconomic lens where we link the performance of public and private real estate and link it to the projections for 100 plus macroeconomic factors to draw some linkages. And then thirdly, we also look at technical analysis or lead lag behavior and its history going to repeat itself. And when you do that, we find that there's a lot of patterns which keep on repeating. And that delta between public and private real estate is quite capturable with a higher and higher degree of predictability, especially as more and more data becomes available in mainstream. In fact, in private real estate, it's actually a very momentum-driven asset class. It keeps going up and then keeps going down. The change of direction doesn't switch very quickly. So there is persistence to some of those periods where private outperforms the public or public outperforms the private. So the point of all of this is that more stronger, more robust portfolios can be generated by thoughtfully combining the private and public segments of real estate. Again, with the private real estate serving as the foundation and REITs serving as a complement.
Great. And can you talk a little bit about the process that you undertake when working with clients that are looking to update their existing real estate strategies?
We think of a process as a continuous loop, and we build a framework around how a repeatable process could be used to design any portfolio across alternatives or across private and public alternative pairings or across private markets. And the same principles apply. Firstly, what is the objective a client is looking to solve for? What are the constraints and what is the opportunity set? Then that leads to how you can one size long-term positions. So there you look at long-term risk, return, correlations, and a host of different frameworks which are more applicable and oriented towards the alternative space to size long-term positions, of course, within broad ranges. Now, once that is set up, then we apply a relative value lens, which is they're looking near term. So let's say 12 to 18 to 24 months, and figuring out where the marginal capital can be deployed in the process on an ongoing basis. That is buying into areas or tilting into areas which are cheap or have forward positive momentum and selling from areas or tilting away from areas which are overvalued and have a downward momentum. And then there is ongoing risk management. And one of the key steps of the process is ongoing evolution, which is fine-tuning the portfolio to adopt to newer beta exposures, newer sectors, and newer styles. All of this is actually practical in the public and private construct because of various levers which clients can pull or products can pull, which is new inflows as a source, cash flows as a source, public to private and private to public rebalancing as a source. Probably the least efficient of sources to effectuate the process would be a private to private rebalancing. But we think of this process as repeatable and a continuous loop, which we analyze and fine-tune and update as new data becomes available.
Pulkit, we've covered lots of ground today, but are there any other points that you'd like to make before we finish?
I think one point I sort of will highlight is that when we look at the public and private real estate space, I think there is a case to be made for global diversification, which exists across these segments. A great example of that happened post-COVID, which is while office vacancies shot up in the US, office vacancies were very low across Asia Pacific. So those markets were more resilient than the US markets, for instance. So there are global portfolios, for instance, because real estate is such a local asset class, we believe that some of that downside could be mitigated by building global portfolios. Last point I'll make as we analyze the public and private space is that there's also now the advent of structures which are the private REITs. And so there's the private core mainstream asset classes or strategies, then there's the private REITs, and then there's the public REITs. We believe that all of them have a role. It's a matter of thoughtfully thinking about their return profile, their sector exposures, their downside risk, and their liquidity, and then sizing it up appropriately to design more robust real estate asset allocations.
Excellent. Pulkit, thanks so much for your time today.
Thanks for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.